Working capital is a key measure of a company's day-to-day financial health and its ability to cover short-term obligations. At its core, this metric is all about liquidity, which simply means how easily a business can pay its immediate bills. To find it, you take a company's current assets and subtract its current liabilities. It tells you what is left over after paying debts. Current assets are things expected to turn into cash within a year, while current liabilities are debts due during that same timeframe. A positive number usually means the company is comfortable, while a negative one indicates they may struggle to meet upcoming financial commitments. Companies aim to turn these components over as quickly as possible to keep cash flowing through the business effectively. Remember that even a profitable company can fail if it runs out of the actual cash needed to run its daily operations. Understanding these metrics helps you analyze business health more clearly. Thanks for watching, and be sure to subscribe for more finance basics.